overall industry you have analyzed. Now we are going to analyze about the single company. The formula for analyzing the earnings per share is equals to net earnings divided by outstanding share. So it is a ratio used to determine a stock's value while considering earnings growth. For every kind of company or an industry, there should be a separate department called research and development department. Hello students, how are you all? I hope you are doing good. So we are going to start with the continuation of the previous session. So let me brush upon what we have discussed in the previous session. So in the previous session, we have discussed about the fundamental analysis of the investment options. So under that, we have learned about economic analysis and industry analysis. So continuing is the today's session about we are going to talk about characteristics of industry analysis. Then we are going to talk about the company analysis and what are the applied techniques in company analysis, and we are going to go with the next topic, that is valuation of securities, debentures and bonds. Okay, so let me give my brief introduction before we move on to the session. So I'm Vaishnavi, Faculty of Commerce from Vidyashram First Grade College, Temple of Excellence, Mysuru. So I'll start with the agenda. So as I've told, in today's agenda, we are going to talk about the characteristics or the features of industry analysis. Next, we are going to learn about what is company analysis. So under EI, so we have talked about economic as well as industry. Next is company analysis. Next, we are going to talk about applied valuation techniques in company analysis. Then next topic is valuation of securities, valuation of bonds and valuation of debentures. Okay, so these are also quite important topics for examination. So we'll straight away move with the first topic, that is called the characteristics or the features of company analysis. So we have talked about the company analysis in the previous class that, so company analysis is about like analyzing about what type of company it is. Okay, so what are the operations of the company? So who are the management people? So what is the raw materials that the company is going to use? So and what are the operation, type of operation? Okay, so and what are the products that the company is going to sell to their customers? What kind of goods or what kind of services the company is going to produce? So like all these, we are the basic things that you have understood in the previous session. So in this today's session, we are going to talk about the features of it. Okay, so under that, first feature or characteristic is about post sales and earnings performance. Okay, so in order to invest into any investment portfolio, we need to first analyze about how the company is going to have the post sales and earnings of the company. Okay, so how the stocks or how the shares is going to work in the market and what is the performance of those stocks or shares in the market. So after the post sales, what kind of earnings or what kind of performance the company is going to do in the market. Okay, so that we are going to analyze. Next is about nature of the competition. That means what kind of industry it is. Okay, so say for example, if it is of an agriculture industry, so what is under that, what kind of industry it is. Say for example, if it is of any oil manufacturing unit. So if you are going to invest on oil manufacturing unit, what kind of oils it is. We have got sunflower oil, groundnut oil, rice bran oil, etc. and etc. Okay, so and who are their competitors? So who are the persons that are going to again invested in those kind of industry portfolios? So what is the nature of the competition? How high it is? So whether the company or the industry is in the initial stage or maturity stage or into the decline stage. So all these needs to be analyzed. So when you are going to invest into any company, so you need to analyze who are the competitors and what are all the types or what is the stage of the industry in the market. Okay. Next is about raw materials and inputs. So as I have told, if it is of any industry or any company that is especially involved in the raw materials, so then that company is going to be having a directly going to impact on the agriculture and monsoons of the country. Okay, so if the monsoons or if the agriculture of the country is less, then the production also will be less and it is going to affect in the performance of the company. If it is more, then it is going to have a direct impact on the production levels and the performance also is going to increase. So you need to analyze like what are the raw materials and what kind of inputs that they are going to purchase for the production of the goods or services. Next feature, attitude of government towards the industry. So that means how the government is going to react, or how the government is going to do the rules or regulations in specific of industry. Like say for example, for agriculture industry we have got more tax benefits, whereas in case of IT or in case of metal, that is steel or iron, so they are also having the company also needs to pay some tax to those kind of industries. Okay, so that means like, so depending upon the type of an industry, the government is going to fix the taxes depending upon the goods that the company is going to manufacture, or the services that the company is going to avail to their customers. So the government is going to adopt or is going to fix some tax rates on it. So if there is a higher tax rates, then the company also needs to perform more and more, so that they can be available for, or they can be easy to pay their corporate taxes. So depending upon how the government is going to react for, or how the government is going to set the rules or regulations, whether it is going to provide subsidies or any loans, or any support from the, in case of financial assistance from the government. So everything needs to be analyzed, and how the government is going to react on it. Okay, so nowadays like government is more and more invested in doing the infrastructure developments, in the improvising the economy, ecological balances, environment related projects. Okay, so based on that also you can fix, or you can decide which is the best portfolio that you want to invest in. Next is management. So management also plays a very important role here. Why? Because so the persons who are going to appointed for the performance of the company, or for the day-to-day operations of the company also is very important. The persons needs to be having a transparent honesty, and should be having an empathy towards the society. So if they are being into the illegal practices, or if they are being into fraudulent cases in before itself, so those kind of people, if they're going to appoint into for their company, so the goodwill of the company also will be on stake. So that's why the management should be always transparent, and it should be always been honest, and it should also provide or do some societal responsibility towards the community where they are going to live. So management also plays a high impact in taking the proper investment decisions. So next point, we have got labor conditions and other industrial problems. So that means if any company is highly labor intrinsic, that means they're highly involved in recruitment of laborers for the day-to-day operations of the industry. So that means like, so there should be, the company or the industry should be enough capable of paying the wages to the laborers. So during that time, there is a high chances of going for risks or knockouts or layoffs. So during that time also, the company's goodwill also will be affected. So if you are going to select any kind of companies which are be highly intrinsic in case of labor and human resource management, so you should also needs to understand what are the practices or human resource practices the company is going to adopt for the welfare of the laborers as well as the human resources in their industry. Next point is about nature of the product line. That means, so what kind of product or what kind of portfolios that the company is going to launch in. Say for example, like we have got ITC. So under ITC, we have got different product portfolios. So we have got food, we have got stationery, we have got eatable items, etc. So each and every kind of item will be considered as an portfolio. Under that, there are again different types of it. Like say for example, if you go for stationery, so there are again books, they have got pens, they have got scale, they have got eraser, etc. Okay, so each and every product will be having will be considered as a product line. Okay, so like that, what is the nature of the product? So how many type of product portfolios that they have got, and what are the extra kind of products that they are going to launch in their product line. So that also needs to be analyzed. So why? Because if the company is going to have the highest number of or larger number of product line, then the customer impact or the customer goodwill or the interaction of the customer also will be in a larger way. So that is also needs to be considered. Next is capacity installed and utilized. That means any new technology or new machinery or new plant has been installed and how they are going to utilize it. So new kind of technological adoptions nowadays we are getting it. So nowadays, like in every kind of industry, we have got robots, we have got artificial intelligence. So those kind of new adoptions are that we are going to adopt for the development of the industries as well as for the higher production capacities inside the plant. Okay, so what kind of capacity or what kind of new research or developments are being taken down inside the company? So that also needs to be taken into consideration, because if the industry is going to adopt for the traditional kind of methods, then the company might not be having the enough performance inside the market. So adopting to the new technology also plays a high impact here. Next feature is research and developments. So for every kind of company or an industry, there should be a separate department called research and development department. Why? Because it has been helpful to analyze the consumer behavior in the market, and you can also will be helpful for getting the feedback from the company or from the customers, and that can be utilized into the developments of the product lines. Okay, so based on the reactions, based on the behaviors of the customers, so research and development is very important. So that is also a place where innovative products or innovative services will be taken birth of. So a proper investment into the research and development is very important. So before you are going to invest into any investment portfolios, you need to analyze how the company is going to adopt, or what kind of practices the company is having for research and development. What are the techniques and what are the practices the company have adopted in developing a product or in developing the society or community, etc. So these are the main important characteristics of the industrial analysis. So next we are going to talk about the company analysis. So that is the next is about, after EI we are talking about the company analysis. Okay, so this is about especially for regarding the company only. Okay, so why? Because it is about the single company that you are going to talk. So we have talked about the industry, overall industry in the previous slide. So this we are going to talk about only the exact company that where you are going to invest in. Okay, so like say for example, if you're going to invest in Tata Powers or Tata Steel, or you're going to invest in Reliance or Vodafone, or there are different kind of companies and different industries are there. So overall industry you have analyzed. Now we are going to analyze about the single company. In company analysis, different companies are considered and evaluated from the selected industry so that most attractive company can be identified. So why we are going to do it? So that the most attractive and the highest performance company can be identified. And the company analysis is also referred to as security analysis, in which stock picking activity is done. It is about like you are going to invest on the company, so that's why you are going to analyze the security related aspects of the company, and you're going to take the best from the stocks that you're going to invest on. So next is about the techniques for company analysis. So in order to understand a company, you need to analyze the balance sheet. Correct? So if you need to analyze how much is the assets and how much the liabilities and how much are the performance of the company, what is the performance of the stocks, what is the performance of the goods that they are going to manufacture in a period of time. Okay, so these are all the kind of techniques that needs to be adopted in order to analyze the best portfolio management. So first is about earnings per share. So this is the overall earnings that the company is going to earn for each and every share that they have launched in. Okay, so the overall earnings of the company is not in itself as a useful indicator of stock's worth. So the low earnings coupled with low outstanding shares can be more valuable than high earnings with a high number of outstanding shares. Okay, so that means like, so if a company is going to have the low outstanding shares with low earnings, okay, so that means low debts, but the company is going to have low earnings is better than the company which is having the higher earnings and higher number of outstanding shares. Okay, the formula for analyzing the earnings per share is equals to net earnings divided by outstanding share. Next is about price to earnings ratio. Okay, the price to earning ratio shows the relationship between stock prices and the company earnings. Okay, so it is going to give the ratio or the relationship between the stock price in the market and the company's earnings in a particular period. So it is calculated by dividing the share price by the earnings per share. So here it is a formula: profit earning ratio is equals to stock price divided by EPS, that is earnings per share. Next technique, projected earnings growth rate or PEG ratio. Okay, so it is a ratio used to determine a stock's value while considering earnings growth. So it is the ratio or a percentage that you are going to analyze. So to determine the stock value of each and every stock into the market, considering the growth rate of the company. So the calculation is as follows: the P ratio divided by the annual EPS growth. That means the P ratio is price to equity ratio. P ratio is price to equity ratio and divided by the annual EPS growth, that is annual earning per share growth. Next technique is price to sales ratio. So it is a ratio that has no earnings. There are the other tools that helps the investors to judge its worth. So new companies in particular often have no earnings, but that does not mean they are bad investments. It is calculated by dividing the market capital, that is stock price divided by the number of outstanding shares. So price to the sales ratio. So how much is the sales or how much is the turnover of a company, so in a particular period of time with respect to the prices of the stock prices into the market. So price to sale ratio is about the ratio about the number of sales or number of outstanding sales that have happened and the stock prices in the current market. Next valuation technique, price to book ratio. Book value is determined by subtracting the liabilities from assets. The value of growing company will be more than book value because of the potential for future revenue. Okay, so the book ratio or the PB ratio is a value the market places on the book value of the company. So book value is all about the value that has been different to the market value. So where you can analyze what is the future revenues of the particular company in the future days. The calculation for the book value is, so book value divided by number of outstanding shares. So this is a ratio with respect to the book value as well as the stock prices into the market. Next technique is dividend yield. So some investors are looking for stocks that can maximize dividend income. Dividend is about the interest amount or the profit share that you are going to get from the investments that you have made. So dividend yield is useful for determining the percentage return a company pays in the form of dividend. So it is calculated by dividing the annual dividend per share by the stock prices per share. So how to calculate dividend? It is by dividing the annual dividends per share divided by the stocks per share. Okay. Next technique is dividend payout ratio. So dividend payout ratio is a fraction of net income a firm pays to its stockholders in dividends. It is a fraction amount or some small lump sum amount that has been paid to their investors based on the dividend options that they have got. So the part of the earnings is not paid to the investors, is left for investment to provide for future earnings growth. Investors seek high current income and limited capital growth, and that has been preferred with the high dividend payout ratio. So the dividend payout ratio has been calculated as dividend per share divided by earnings per share. Next technique is return on equity. So as you know that equity is all about ownership shares. So equity does not have a particular maturity period, that does not have any particular percentage or the exact amount of returns what you are going to get on the equity shares. So return on equity is a measure of how much in earnings a company is generated in a time period compared to its shareholders' equity. So it is typically calculated as on a full year basis, either at last fiscal year or the last 4 quarters. So it has been calculated on the either last year or based on the last 4 quarters of the previous year. So those are the important techniques that needs to be adopted in order to understand the company's performance into the stock market. So next topic is about valuation of securities. So valuation, why we need to do the valuation? In order to find out the book price or the market price into the of the particular asset or a commodity or a security in the current market. Okay, so valuation analysis is a process to estimate the approximate value or worth of an asset. So whether a business, equity or fixed income security, commodity, real estate or other assets. So for what we are going to evaluate? So based off any businesses, of any equity shares or any fixed income securities that you have got, or any commodity or any real estate properties or fixed assets or any other assets. So on all these we are going to do the valuation. So in finance, valuation is a process of determining the fair market value of an asset. Is a process of determining the fair market value. Equity valuation therefore refers to the process of determining the fair market value of a equity security. So it is about determining the equity or determine the market value of the particular shares or securities in the current market price. So next is about reasons for valuation of security. Why we need to valuate the securities? The first is for the liquidation purpose. So that means when the company is going to dissolve or they're going to stop the operations after a period of time. So during that time also the valuation of the liquidation will be helpful so that they can analyze how much percentage or how much value of an assets and how much value of liabilities are left out in the company. Next is for mergers and acquisitions. So if any merger is been taking place between two companies, or if any company is going to acquire the other company, during that time also valuation of the assets and liabilities is important so that they can know what is the actual performance or actual percentage of the assets or liabilities in their business. Next reason, in order to use the security as collateral. So in order to exchange the goods for any other price or for any money related aspect. So during that time also the valuation of security will be helpful in order to analyze what is the exact market price of the commodities or fixed assets of in the market. Next reason, for the sale of the securities. So during the sale or during you are going to sell it to the other people, so during that time also evaluation of the security is important. Next is for quotation or listing in the stock exchange. So if a company is going to start their stock exchange or IPO for the first time in the stock market, during that time also evaluation of security is important so that the SEBI needs to understand what is the financial aspect percentage or level of the company inside the market. Okay. Next is for insurance and tax purposes. For payment of taxes or for payment of insurance or for the maturity of insurance premiums. So for that time also the evaluation of securities will be helpful. Next is valuation of bonds. Okay, so the valuation of bond is a technique for determining the theoretical fair value of a particular bond. Bond valuation includes calculating the present value of bonds, future interest payments, and it is also known as cash flow, and the bonds value upon the maturity. So it is known as the face value or par value. So the basically bonds will be for a longer period of time. Okay, so we are going to evaluate the bonds in order to analyze the fair value of a particular bond. It includes the calculation of present value of a bond, of the future interest payments that we are going to get for the bond that you have invested in. Okay, so we have got government bonds, we have got municipal bonds, and we have got local bonds. So if you're going to invest on it, you're going to analyze what is the present value as well as the future value of the interest of payments that you're going to get in the future purposes that you're going to invest in right now. So we have got two types of traditional methods, that valuation of bonds. Under that, first is traditional method, that is discounted cash flow method. So this is the method widely used in bond valuation technique that calculates the present value of the bond's future cash flows, including the coupon payments and principal repayment. So it is a calculation of finding out the present value of the future interest payments that we are going to receive in the future, depending upon the principal repayment as well as the coupon payments that has been you're going to get on the bond investment. Next technique is yield to maturity method. So the yield to maturity method is another popular bond valuation approach that computes the total return of an investor can be expected to receive if a bond is held to maturity. That means yield is what the period, okay, the period to maturity is about. So you're going to analyze how much value or how much amount you're going to get on the future that you're going to invest on currently. Okay, so this method considering the bond's current market price, face value, coupon rates and time to maturity, allowing the investors to compare bonds with different characteristics. So this method you're going to analyze what is the price value, what is the face value, what is the coupon rate and what is the time to maturity. So these will be analyzed in order to compare with to the other characteristics features of the other types of bonds. Next method is option adjusted method. So we have got callable and puttable bonds. Just like the options, we have got two types. Callable bonds grant the issuer the right to redeem the bond before its maturity date, while puttable bond allow the bondholder to sell the bond back to the issuer before the maturity date. Okay, so I'll repeat. Callable bonds grant the issuer the right to redeem the bond before its maturity date. So the callable bond holders will be having the right to redeem. That means get back the amount what they have invested before the maturity period itself. Whereas the puttable bond allows the bond holders to sell the bond back to the issuer before the maturity itself. So the puttable bond here, they are having the right to sell the bonds to the issuer, those who have issued the bonds to the person or the bond holder before the maturity itself. So these embedded options can affect the bonds valuations as they influence the affected cash flows and risk profile of the investment. So callable bonds and puttable bonds will be especially for hedging the risk to the other persons. Okay, so this is about the valuation of the bonds. So next is valuation of debentures. So debentures are again a financial instruments or a debt instruments for a longer period of time. Okay, so the financial instrument usually issued by the companies and government to raise capital to finance their businesses without forfeiting control of the company ownership. Okay, in other words, debentures are simply loans taken by the companies to raise short-term to medium-term loans needed for expenses or expansion and do not provide the ownership of the company. So debentures are a kind of a debt instruments that are been issued by the government or by the financial institutions or any companies for a short-term or long-term or maybe medium-term purposes. So wherein they are going to raise the loans for meeting their expenses and for expansion, and that does not provide any kind of ownership to the investors. Okay, a debenture is a debt instrument just like the fixed deposit usually issued by a company. Okay, so you don't own the company but still you are going to provide the or issue the loan to the people who are in need of, but you are going to get exact or maturity value after the debenture period has been matured. Okay, this is about the valuation of debentures. So in the next session we are going to talk about the third unit, that is called risk and return, types of risk and calculation of expected risk and return. So we are going to talk what do you mean by a risk, what are the types of risks we have got, and calculation of risk and returns of, that means expected risk and returns of the risks, okay, or of any portfolios. So in this today's session we have understood about the company analysis, characteristics of industry analysis, what are the valued applied techniques in order to analyze the proper company performance in the stock market. So and we have also learned about valuation of securities, valuation of bonds and debentures. So these are also important topics for you. So I especially stress on EIC analysis or EIC framework. So I can expect a question on EIC framework. So I request you to have a thorough knowledge about what is EIC framework. Okay. So and unit 3 is also important. So you are going to expect the calculation part questions in the final examination also. So I'll meet you in the next session. Then thank you so much.